Hey guys, what's up? Welcome back to my financial focus. In today's video, I'm going to be looking at the income statement and I'm going to be breaking down each line item of the income statement so that we could get a better understanding of what it is we're actually looking at when we read through the financial statements of a business. So just to start off, we can see right off the bat that the income statement is broken up into 3 different years. And just to clarify, some people look at this and they think, well, this is the entire income statement, all 3 of these years. But in actuality, an income statement is only made up of 1 year. And so this is actually showing 3 separate income statements, one for 2018, 2019, and 2020 for the year ending December 31st. We also see up here that it says in millions, and this is basically just a metric that we multiply each of these values by in order to get the actual absolute dollar amount that this value is representing. So for example, this right here says 26,184. Let me zoom in a little bit here so people can see it. 26,184. But since it's in millions, what this actually is $26,184,000,000. So that's what their revenue was for 2020. And so that's just like a quick little look at the little metrics and the labels up here. Now I'm going to get into what each of these line items on the left side of the income statement mean. So first and foremost, we see at the top here revenue, and revenue is basically the total amount of income that's generated by the sale of goods or services in a company's primary operations. That's the key point, in their primary operations. And sometimes people refer to revenue as gross sales or as the top line because, as we can see, revenue is at the top of the income statement. So sometimes people call it the top line. And there are actually 2 different types of accounting methods when it comes to recording revenue on an income statement. There's the accrual-based accounting method and the cash-based accounting method. Most companies that are pretty large, like Tesla, for example, use the accrual-based accounting method, because the cash accounting method recognizes revenue and expenses only when cash changes hands, but the accrual-based accounting method recognizes revenue when it's earned, and it recognizes expenses when they're billed out, not when they're paid. So for example, if Tesla in this case were to sell a car to a customer, but the customer bought the car on some sort of contractual payment period agreement where they would pay off the car over the next 3 years, Tesla at that point doesn't actually receive the cash for that car payment. So if this were cash-based accounting, then there would be no revenue recognized because they didn't receive the cash. But with the accrual-based accounting method, if Tesla sells a car to someone and it's for a 0% down payment, so Tesla doesn't actually receive any cash in that transaction, they would still record the total revenue that they expect to collect in cash in the future at the point that they actually deliver the car to the customer. So if they deliver a car to the customer on December 30th, 2020, and it's a, $50,000 car or something, then they will recognize $50,000 worth of revenue for 2020 for that car sale, even though they didn't receive the cash for the car. That's basically what the accrual-based accounting method points out. The next line item we see is automotive sales, automotive leasing, and total automotive revenues. And I'm not going to get into this into too detail because I did do an intrinsic value analysis of Tesla in the past where I talked about these different things in regards to Tesla. And this video is more so focusing on breaking down an income statement from a more accounting-based perspective. So I'm not going to go into this in too detail, but just to sum up, just to touch on it a little bit, the automotive sales for Tesla in this case, this is just revenue that they bring in from deliveries of new vehicles and also pay-per-use charges from their supercharger stations, internet connectivity, their full self-driving features, and then their over-the-air software updates. And all of this information that I get as to how I figure out what each of these individual line items are for a particular company, I can get from the notes to the financial statements, which in this annual report is on page 59. We can see right here, it says notes to the financial statements. And if I scroll down right here, we see eventually they start talking about revenue by source, and they get into detail exactly what each of those line items mean. So automotive sales revenue, automotive leasing revenue, as we can see right here, If I scroll down more, they talk about their services and other energy generation and storage segment. And so we can see from that, if I scroll back to the income statement here, that we get a pretty good detailed look into what each of these line items mean if we don't actually know just off the top of our heads what this line item is encompassing. And so next up, automotive leasing. This basically is just in regards to their operating lease programs internationally, US, Canada, and in Europe, where they basically lease a vehicle to someone who wants to use a vehicle for a specific time period, say 48 months or so. And then at the end of that leasing period, that person is given the option to buy the car or do something else with it. And that's basically the revenue that they bring in from the leasing revenues. And then they add those up. That gives them the total automotive revenues right here. And the energy generation and storage for Tesla, this just consists of the sale of solar energy systems and energy storage systems to residential and large commercial grade customers. And then the services and other segment, which I got all this information from the notes to the financial statement, so it's a good exercise to look at the notes to the financial statements when someone's analyzing financial statements for a company. The services and other revenue segment just consists of sales of used vehicles, retail merchandise, and also vehicle insurance revenue. And then once they add up the total automotive revenues with the energy generation and the services and other revenue segments, they get their total revenue number right here. So this is the gross sale amount, or the top line for Tesla in 2020 would be this number right here, total revenues. Then cost of revenues is basically just the total of all costs that are incurred directly in producing, marketing, and distributing the products and services that a company provides to their customers. And remember, like I said before, with the accrual-based accounting method, the revenues and the expenses are recorded when they are billed, not necessarily when they're paid. So even though Tesla might not have actually paid cash for these costs yet, if they sell a car in 2020, then whatever it costs to build that car, those costs they will record in the same period, even though no cash has entered or left the business. Right here for automotive sales expenses, this basically is made up of direct parts, direct labor, and manufacturing overhead, as well as depreciation costs for tooling and machinery. Automotive leasing is the amortization of their leased vehicles over the lease term, and also the cost of goods sold associated with the direct sale leases and warranty expenses. And then they add those up. That gives them total automotive cost of revenues. That's just the two previous line items added together. Energy generation and storage expenses is made up of direct and indirect material and labor costs, warehouse rent, warranty expenses, and also different overhead costs. And then services and other is made up of costs for retail merchandise and costs to provide vehicle insurance. And then once they add up the total automotive cost of revenues with the energy generation, storage, and services and other, they get the total cost of revenues line item right here. And then that gives us the gross profit. And gross profit is basically the profit that a business makes after subtracting all of the costs that are related to manufacturing and selling the products or services that that company provides. And it's calculated by subtracting the cost of goods sold, which is this total cost of revenues right here, from their total sales, which is total revenues right here. So total revenues minus total cost of revenues is equal to the gross profit. And then right here, operating expenses. These are the ongoing day-to-day costs of running a business, a product, or a system. And the goal of any company is to maximize the output relative to their operating expenses. They want to get as much output as possible from their operating expenses and keep these expenses as low as possible. Or if they are going to increase their operating expenses, then they want to see a lot of value come from that. And the first operating expense we see right here is R&D, or research and development. And research and development is basically when a company invests in its goods or services, as well as any intellectual property like patents and trademarks generated from the process. And they generally incur these expenses when they're finding or creating new products or services. And then selling, general, and administrative expenses. These are the everyday operating expenses that go into running a business, like rent, salaries, advertising and marketing expenses, as well as distribution costs. And then restructuring and other. This is basically just a one-time expense that a company incurs when they are reorganizing their operations. And so an example of this might be when a company is laying off employees, or they're closing manufacturing plants, or they're shifting production of a certain good to a new location. And then right here we see total operating expenses. This is just research and development, selling, general, and administrative, and restructuring costs all added together to give us our total operating expenses. And then we get income from operations, otherwise known as earnings before interest and taxes, or EBIT. And in accounting and finance, earnings before interest and taxes is basically a measure of a firm's profit that includes all of the income and all of the expenses, except for the interest expenses and the income tax expenses, which come after this line item. So we basically just take the gross profit and we subtract the total operating expenses, and that gives us the income from operations, or as we see in previous periods, it was a loss from operations because the total operating expenses were greater than their gross profit, as we see right here. And the next line item is interest income. And interest income is basically the amount paid to an entity for lending out money or lending out another use of funds or something like that. And on a larger scale, interest income is basically earned by an investor's money when they invest in some sort of large scale project or something like that. And so this is basically just the income that Tesla brings in from interest, but not from their primary business operations. And then the next line item we see is interest expense. And this is the exact opposite of interest income. If interest income is the interest that Tesla collects from loaning out their money, interest expense is the interest that Tesla pays to other entities for borrowing money from them. And so it's basically just the cost of borrowing from banks, bond investors, and other sources like that. And we can see for Tesla in this case that their interest expense was much larger than their interest income. And then right here we see other expense or income, net. And the reason why it says net is because there is probably some other income as well as some other expenses that Tesla incurs. And so net is basically just demonstrating that whatever value pops up here is whatever the other income minus the other expense was. And so this is the net of other income minus other expense. And this line item basically usually comes not from their main business, but from things like interest or rent and gains from selling fixed assets and things like that. And then after we subtract these three line items or add them in the case of interest income from the income from operations, we get income or loss before income taxes. And it was positive in 2020 because they had less of these expenses than total operating income or income from operations. But for the previous years, 2019 and 2018, we see that that was negative because their income from operations was already negative, and then they had all of these other interest expenses and things like that that added on to their negative amount. Then underneath this line item, we see provision for income taxes. And by the way, I skipped ahead here, but with income before income taxes, this is actually a pretty good metric to use when comparing businesses to each other, because there are obviously different tax rates for different jurisdictions. And so it might not be fair to compare Tesla's income to, say, another car company or something like that that comes from a jurisdiction with lower tax rates. And so comparing income before income taxes shows us the income of each business before they are taxed at the different tax rates for their given jurisdiction. And then right here, provision for income taxes. This is basically just an estimate amount of income tax that a company is legally expected to pay to the Internal Revenue Service at the end of the current year. And obviously, income taxes are usually paid in the next year. And so since this income statement was created for December 31st, 2020, and all of the taxes for December 31st, or not for December 31st, but all of the taxes for 2020 will be paid probably in 2021. But they're creating this income statement for people to read at the end of 2020. And so they don't know exactly how much the income taxes are going to be that they're going to be paying. So they just do this estimate here, provision for income taxes, before they actually pay the income taxes in the months that follow this creation of this income statement. And then net income loss is basically just an entity's income minus cost of goods sold, expenses, depreciation and amortization, interest, and taxes for the accounting period. And then right down here, we see net income or loss attributable to non-controlling interests and redeemable non-controlling interests in subsidiaries. And what this is basically the portion of net income or loss that is attributable to non-controlling interests, which are essentially entities that own less than the majority of shares in a subsidiary for a company. And these are deducted in order to derive the portion that's attributable to the parent, or in this case, to the common stockholders. And then also right here, we see net income attributable to common stockholders. This, as I just said, is net income minus the amount that's attributable to non-controlling interests, but we're also subtracting the amount that's given to preferred shareholders through things like preferred dividends. And so after we subtract that, we get the net income attributable to common stockholders for the end of the year. And then right here, we see less buyout of non-controlling interest. Less basically just means minus, so this is an expense. And then buyout of non-controlling interest. This is basically just when a company acquires a non-controlling interest. So if somebody has a non-controlling interest in a company, they can be bought out by the parent company, and this would be an expense. Then we see net income used in computing net income per share of common stock. So the net income per share of common stock are these metrics right down here. And so this value is basically just letting us know what number, the actual net income amount that Tesla used in their calculations for their earnings per share. And we can see right here, it looks like they basically just took the net income attributable to common stockholders and then subtracted the amount they paid to buy out non-controlling interests, and that gave them the number that they used to compute their earnings per share. Then right down here, we see net income per share of common stock attributable to common stockholders. And we see right here, it's broken up into two parts, basic and diluted. The basic earnings per share is just the earnings per share calculated by taking into account the outstanding common shares. But the diluted earnings per share is an amount of earnings per share that doesn't just include the common shares, but also includes convertible debt securities and also options, warrants, and things like that. And so obviously the diluted earnings per share amount is going to be smaller than the basic earnings per share amount, because the diluted earnings per share amount is using a larger number of shares, since it's including things like options, warrants, and convertible debt. And so since earnings per share is calculated by taking net income and dividing it by the number of shares, if in this case they're including all of those extra options and warrants and things like that, then the denominator for this equation is going to be larger, and so the earnings per share amount is going to be smaller. And then right here, it says weighted average shares used in computing net income per share of common stock. This account is basically just letting us know exactly what the number of shares was that they used in the calculation. So this tells us the net income amount that they used, and this tells us the amount of shares that they used for their calculation. So the 690 divided by the 933 gives us 0.74, and the 690 divided by the 1083 gives us the 0.64 for diluted earnings per share. So this is just the outstanding shares, and then diluted is including the outstanding shares, options, warrants, and convertible debt, and that increases the amount of shares used in the calculation. And lastly, down here, we see something interesting that says prior period results have been adjusted to reflect the 5-for-1 stock split. And what this is basically in August of 2020, Tesla's board of directors declared a 5-for-1 stock split for the company. And this obviously has an effect on the amount of outstanding shares in the business. And so that's going to affect the earnings per share amount. And we can see that in their 2019 annual report with their income statement, we can see that they experienced if I scroll up here, it says 2018, 2019. We can see they experienced a basic earnings per share for 2018 of 572 and then for 2019 of 492. But after they did the 5-for-1 stock split, the amount of shares that they were using to make their calculations increased. And so this amount is basically now in their 2020 report divided by 5, as we can see right here. It's not 572, it's now 114. And this one is not 492, it's now 0.98. And so that basically just lets us know that these values were adjusted for the 5-for-1 stock split. And that basically sums up everything there is to know about the income statement. I tried to be as detailed as possible in this video, but if I left anything out, definitely let me know in the comment section down below. I would be happy to answer any questions. Leave a like on the video. It helps this channel out a bunch. And the rule is on YouTube that if anyone made it to the end of the video, they have to subscribe to the YouTube channel. So go ahead, click that red subscribe button. It would really help this channel out a lot. And I'll see everyone in the next video.